Good afternoon.
The time has finally come. The Fed has pivoted, cutting interest rates by 50 basis points on September 18th, making it the first rate cut in 4 years. In this video, we'll quickly cover what this could mean for the markets, as well as other important developments you should keep your eye on. To provide context to those who aren't caught up on how the Fed's interest rates affect the economy, very simply put, the idea is that low interest rates stimulate the economy as the cost of loans drop. This encourages businesses to expand, consumers to spend more, and so on. Low interest rate environments are thus good for risk assets like stocks and crypto. Recall that the Fed has a dual mandate of curbing inflation while maintaining minimum unemployment. Inflation has fortunately cooled off this year, but unemployment rates are starting to tick up in the recent months. The latest labor data will be released on the morning of October 4th, so that may be worth noting when it comes out, along with the market's reaction to it. After the announcement of the cut, the market has gone on a little rally, and the momentum we've seen so far is noteworthy. However, are we really out of the woods? While everyone is all but certain that the Fed will continue cutting rates into 2025, the debate has now focused on whether the Fed can pull off a
soft landing,
a scenario where inflation is successfully lowered to the 2% target without inducing a recession. One thing to consider is that monetary policy takes time to have a real impact on the economy. In line with the higher for longer promise by the Fed, rates had been held steady at 5.25 to 5.5% for over a year before the latest cut, and it could take time before they are lowered enough to provide relief to people. Some argue that the latest larger-than-expected half percentage cut by the Fed suggests that there is weakness in the economy, though Powell denies this. Recently, though, one other historically consistent indicator of incoming recessions has also triggered, and we're not talking about the SOM rule, which had also triggered in early August. This time, we're back to shining a light on the 10- and 2-year yield curve, which has durably uninverted since the start of September. When longer-dated Treasury yields are lower than shorter-dated ones, it causes an inversion of the yield curve and generally signals a troubled economy. However, the yield curve can stay inverted for a long time without seeming to have an effect on the economy, and historically, it has been the uninversion of the curve that signals an incoming recession. That said, nothing is set in stone, and many economists and analysts have differing views on the importance of this indicator and whether it still applies in the same way today. Next up, let's look at Bitcoin dominance, which may provide some clues on how to navigate the markets. Bitcoin dominance measures the share of Bitcoin's market cap against altcoins, and its rise indicates the rotation of capital from high to lower risk assets. In the week prior to the rate cut, Bitcoin dominance had made another significant move higher, closing in on 60%. Though the recent rally saw many altcoins holding their own, which led to a slight dip in the metric. Bitcoin's rise in dominance has been astounding, but will certainly reverse when conditions shift to favor more risk-on investing, when people are more interested in altcoins. Therefore, if Bitcoin dominance starts to break its uptrending market structure, it may be time to put on your altcoin hats. There's so much happening in the space lately, from Sony's new Layer 2 chain, MakerDAO's rebranding the Sky, to Bitcoin staking and more, that we'll be covering them in their own standalone videos. So make sure you subscribe to stay tuned.